All right, let's get right into it. In a market that is completely obsessed with big tech, there are these two silent giants that have been quietly delivering knockout returns. So today, we're putting them in the ring for a head-to-head showdown. Flex, the value play, versus Jabil, the growth engine. Let's find out who comes out on top.
And this is where it gets crazy. I mean, just look at this chart. While everybody and their brother was chasing the AI hype train, Flex and Jabil have been on an absolute tear. Get this, Jabil has smoked the tech-heavy NASDAQ by over 7 times in the last 5 years. These aren't just good returns, folks. This is market-crushing performance, and it's been happening right under our noses.
Okay, so let's kick things off with round 1. It's time to meet our contenders. These are the hidden champions of the global supply chain, the companies literally building the tech that we use every single day.
All right, here's the tail of the tape. So Jabil is a little bit bigger by market cap, and it definitely carries a premium price, with a PE ratio sitting over 40. On the other side, you've got Flex positioning itself as the value leader, with a more modest PE under 29. So right out of the gate you see it, right? It's that classic value versus growth showdown.
Okay, ding ding, time for round 2, the profitability battle. This is where we pop the hood, look at the engine, and see who's really making the money, and more importantly, who's doing it with more efficiency.
And in this first exchange, Jabil comes out swinging and lands a solid hit. It pulls in slightly higher revenues, and as you can see from these little thermometers, it's got a better gross margin at 8.9%. Now that might not seem like a lot, but it suggests they have stronger pricing power, or maybe they're just building more complex, higher value stuff. First point goes to Jabil.
But hold on, Flex isn't taking that lying down. It comes right back with a strong counterpunch. This is the efficiency round, or as I like to call it, squeezing the lemon. And even though Flex has lower gross margins, it is projected to actually take the lead in operating margin in 2025. How's it doing that? Well, by being way more efficient with its overhead costs. Point to Flex for pure operational discipline.
And wow, here comes what I think is Jabil's knockout punch, the quality metric, return on capital. Just look at that return on equity, or ROE, a massive 45.7%. That means for every single dollar of shareholder equity, Jabil is generating way more profit. This right here is the single biggest reason its stock commands such a premium.
But don't count Flex out just yet. It answers back with pure hard cash. Check out this incredible turnaround in free cash flow, going from nearly -$2 billion all the way to over $1 billion. And here's the key part. Flex is better at turning its net income into actual usable operating cash. In the world of finance, cash is king, and Flex is proving it's a cash-generating machine.
So it feels like we're pretty much tied up. Now we're heading into the final rounds, where we're going to look at strategy, risk, and reward. See, it's not just about the numbers on the page, it's about how they actually play the game.
Now this is a strategy that both of these companies are absolute masters at. I like to call them share cannibals. They use their cash to aggressively buy back their own stock, and they've cut the number of shares out there by over 20% in just a few years. It's a kind of financial engineering that automatically boosts earnings per share for investors, even if the top-line revenue stays totally flat.
So where does all that cash actually go? Well, this flowchart tells the whole story. First and foremost, that cash from operations is plowed into buybacks. Reinvesting in the business comes second. And dividends? Well, they're a distant third, or in Flex's case, they don't exist at all. So the big takeaway here is clear. Don't buy these stocks for income. That's not their game. They're all about capital appreciation.
Okay, now this next part, this is where things get really interesting and kinda counterintuitive. For companies so deep in the tech world, you'd think they'd be spending a ton on research and development, right? But look at this. Flex spends 0. Jabil, barely a rounding error. It's practically nothing.
Which, it makes you ask the obvious question. Wait a minute. Aren't these tech companies? Why on earth is R&D spending so low? And here it is, the aha moment. That low R&D, it's not a bug, it's a core feature of their business model. They aren't the ones taking on the massive, expensive risk of designing new products that might totally fail in the market. No, they are manufacturing experts. They execute other people's designs, and they do it flawlessly. They've completely removed innovation risk from their books. And this core difference in strategy, it shows up right on their balance sheets. As you can see from these speedometers, Jabil runs hot. It uses a ton of leverage, over 11 times debt to equity, to get those monster returns. Flex, on the other hand, is all about that fortress balance sheet, keeping debt super low.
two completely different philosophies on risk.
And all of this brings us right back to the beginning. Valuation. What are you actually paying for? With Jabil, you're paying a massive premium, almost 15 times its book value. The market is pricing in perfection. With Flex, though, trading at only 2.5 times book, you're getting what investors call a margin of safety. You're just paying a lot less for each dollar of the company's assets.
All right, the final bell is about to ring. It's time for the final verdict. We've seen the financials, we've broken down the strategies. Now let's see how it all adds up.
So as we look ahead to 2025, what we're seeing are two different kinds of momentum building. Flex is showing some incredible acceleration. Its operating margins are hitting a 5-year high, and free cash flow just smashed through the billion-dollar barrier. Jabil, meanwhile, is a picture of consistency, just maintaining its elite-level ROE at a massive scale, even if its own margins are softening just a little.
And that brings us to our final scorecard. The check mark for growth and efficiency, that goes to Jabil. But value and safety, that goes to Flex. Cash generation, it's a draw because both of these are absolute powerhouses. The result? Well, honestly, it's a dead heat. The real winner here truly depends on your own personal investing style.
So it all boils down to this one simple choice. Do you want the high-performance, screaming fast sports car? That's Jabil. You get high leverage, incredible momentum, and elite returns. But you gotta pay that premium price for the performance. Or do you want the ultra-reliable, get-you-anywhere tank? That's Flex. A fortress balance sheet, a value price to get in, and one heck of a turnaround story.
So, the premium sports car or the reliable tank? After seeing all the data, all the strategies, and all the risks, the only real question left is, which one belongs in your garage?